Imagine walking into your bank tomorrow morning. You check your balance. The number is there. Comforting, familiar. Now imagine everyone else does the same thing. At the same time. Not to spend, not to invest, just to get paid. To turn numbers into actual money. That's when the trick is exposed, because the uncomfortable truth is this: most of the money you think exists doesn't. At least not in the way you think, and banks didn't steal it. They didn't print it in basements. They followed the rules. Let's rewind. Right now, this topic matters more than it sounds, because debt levels are high. Interest rates moved faster than anyone expected. And trust in institutions is thinner than it looks. When people say the system feels fragile, this is the system they're feeling. So let's strip it down. Picture a bank as a warehouse. You deposit $100. In your mind, that money sits on a shelf, waiting, but the bank doesn't see a shelf. It sees permission. By law, the bank is allowed to keep only a small slice of your deposit as actual cash. The rest can be loaned out. So your $100 goes in. The bank keeps, say, 10. The other 90 gets loaned to someone else. Here's where the quiet magic happens. You still see $100 in your account. The borrower now sees $90 in theirs. No money moved. No cash duplicated. But suddenly, the system shows $190. That's the trick. Not fraud. Not a loophole. Just accounting, and it doesn't stop there. That borrower spends the 90. The recipient deposits it into another bank. That bank keeps a fraction, loans the rest again. The same original money stretches, and stretches, and stretches, like a single slice of bread, feeding an entire neighborhood as long as no one asks for the loaf. This is called fractional reserve banking. But forget the name. Names make it sound complicated. The idea is simple. Banks don't lend money. They create it. When they lend, the loan itself becomes money. Your mortgage, your car loan, your student debt, all of them are fresh money injected into the system. That's why credit booms feel good at first. Everyone feels richer. Spending rises, asset prices climb, and politicians love it. Because growth looks real. Jobs appear, tax revenue increases, but here's the uncomfortable math. All of that money comes with strings. Every dollar created this way is born owing more than itself, interest, which means the system only works if tomorrow is always bigger than today. More borrowing, more growth, more confidence. Now let's talk about what happens when confidence cracks. Not a crash, not panic yet, just hesitation. People stop borrowing, banks get cautious, loans slow down, money creation slows with it. Suddenly, the system isn't expanding. It's shrinking, because when loans are paid back, money disappears. It doesn't go anywhere. It vanishes, the same mechanism that creates. Money also destroys it. That's the part. Almost no one tells you. So when everyone tries to get paid at once, they're really trying to convert promises into reality, and the system wasn't built for that. Banks don't have everyone's money. They have everyone's trust. If withdrawals stay normal, everything looks solid. If too many people demand cash, the illusion collapses. This isn't theory. It's happened. Bank runs aren't caused by insolvency at first. They're caused by synchronization, everyone moving at once. The irony is painful. Individually, everyone is being rational. Collectively, the system breaks. And here's the quiet absurdity. The bank can be healthy and still fail, because health in this system doesn't mean having the money. It means believing no one will ask for it. Central banks exist to hold this together. When things wobble, they step in. They lend to banks. They create reserves. They calm nerves, but notice something important. Central banks don't fix the trick. They scale it. They make sure the game continues by backstopping confidence, which works until inflation reminds people that money creation isn't free. When too much money chases the same goods, prices rise. Not because companies are evil. Not because workers asked for too much, because the math demanded it. And now we reach the part where hype meets reality. We're told money is backed by governments, or GDP, or productivity. In practice, it's backed by belief in future repayment. Your money works because we all agree it will. The moment that agreement weakens, banks stop lending. Markets freeze. Liquidity evaporates, and suddenly, money out of nothing reveals its cost. This is why crises feel confusing. One day everything functions. The next day, nothing does. No laws changed overnight. No vaults emptied, confidence did. Zoom out far enough, and the risk becomes clear. The global economy isn't a machine. It's a network of promises stacked on top of each other. Banks create money by betting the future will show up on time. Most of the time, it does, but every so often, history asks an uncomfortable question. What if it doesn't? What if growth slows permanently? What if debt can't be rolled forward? What if trust erodes faster than policy can repair? Because when banks create money from nothing, they're really borrowing stability from tomorrow, and tomorrow doesn't sign contracts. So here's the thought to sit with. If your money exists because someone else owes it, and their ability to repay depends on even more money being created, at what point does the trick stop being clever and start becoming fragile? That's not a crisis prediction. It's a design question, and we're all inside the answer.